RCAT Holdings Q3 2025 earnings breakdown.
Hey everyone, welcome back to Earnings Digest Daily. I'm Alex.
And I'm Jamie. Today we're diving into the latest results from RCAT Holdings, ticker RCAT. This small-cap company builds military-grade drones and unmanned systems. So if you're interested in defense tech or emerging growth stocks, this one's for you.
We'll unpack their Q3 2025 earnings, talk about the booming revenue numbers, discuss expenses and margins, and share our candid take on the business. So grab your coffee and let's get into it. Now let's look into this company and learn more about what they do.
For those new to RCAT, RCAT is a U.S.-based drone company targeting defense and public safety customers. Their flagship product is the Teal 2 Small Unmanned Aircraft System, SUAS, used for reconnaissance. Recently, they've also introduced a low-cost portable system called RCAT for intelligence, surveillance, and precision strike.
The big milestone this year was winning a contract under the U.S. Army's Short-Range Reconnaissance Tranche 2 program, or SRRT-2. This contract could be worth around $35 million over time, providing production visibility and validating their technology.
RCAT shares are volatile because the business is still early stage, but Q3 2025 showed explosive growth that caught investors' attention.
Let's look into the headlines and digest these numbers.
Let's start with the headline figures. In Q3 2025, RCAT reported revenue of $9.6 million. That's up 646% year-over-year and 200% sequentially. In plain English, they did more than 6 times the revenue they generated a year ago. Even more impressive, this quarter's revenue is almost equal to the company's entire fiscal 2024 revenue. How? They delivered large batches of the Teal 2 drone to the U.S. Army and began pilot shipments of the new RCAT platform.
Gross profit was $637,502, giving them a 6.6% gross margin. Last year, they actually had negative gross profit on a much smaller revenue base. So turning positive here is a big deal.
But there's a flip side. Expenses. Research and development jumped to $5.97 million versus $1.88 million last year. Sales and marketing hit $2.98 million. And general and administrative costs rose to $9.22 million. Total operating expenses were $18.17 million, resulting in an operating loss of $17.53 million. So yes, they're spending aggressively to win big contracts.
Earnings per share came in at around negative $0.16. Analysts expected a smaller loss, about negative $0.09. So investors need to weigh the massive revenue ramp versus the deepening operating loss. What about their growth? Are they growing? The revenue surge is almost entirely thanks to the U.S. Department of Defense. RCAT shipped hundreds of Teal 2 drones as part of the SRR contract, which aims to equip soldiers with lightweight reconnaissance drones that can be deployed in under a minute.
They also began delivering early units of the new RCAT product line. This system is smaller, cheaper, and designed for both ISR, intelligence, surveillance, and reconnaissance, and precision strike missions. According to CEO Jeff Thompson, RCAT could open the door to international customers because it's export-friendly.
Another point. Management indicated that Q4 revenue could reach $20 million to $23 million, meaning they expect to more than double Q3 sales in the next quarter. If achieved, Q4 alone would surpass all revenue generated in the past several years combined. That shows how lumpy but powerful these defense contracts can be. Let's delve into their cash and balance sheet.
To fund this growth, RCAT has raised capital a few times. As of September 30, 2025, they reported around $49 million in cash and marketable securities on a pro forma basis. That provides runway to fulfill existing contracts and invest in R&D. However, the company continues to burn cash. They used about $17 million in operations and investments this quarter, so future contract payments and perhaps additional capital raises will be critical.
What about their guidance and outlook?
Management maintained their full-year revenue guidance of $34.5 to $37.5 million. Given they've already booked roughly $10 million year-to-date, hitting the high end would require a blowout Q4, which they believe is possible if SRR production ramps smoothly.
Looking further ahead, RCAT is positioning itself as a leading supplier of small UAS for the U.S. military. They're also eyeing commercial applications like critical infrastructure inspection and border security. New product launches are slated for 2026, which could diversify revenue sources beyond one major contract.
CEO Thompson is quite bullish. He said on the call that Q4 revenue could be more in a single quarter than the company has made in any full year. That level of optimism is unusual, but it underscores how transformational the SRR program is.
What about risk of dilution, and where do we see RCAT headed?
Now for our personal take. On the positive side, RCAT has finally proven demand for its drones and turned gross margins positive. The military contract gives them credibility and a predictable revenue base, at least for the next year.
But investors should be aware of a few risks. Customer concentration is the big one. Right now, nearly all sales come from the U.S. Army. If there's a budget delay or performance issue, revenue could drop abruptly. Also, the company's operating expenses are exploding. That's necessary to scale manufacturing and win contracts, but they'll need to show they can control costs over time.
Another factor is dilution. To fund development and fulfill the SRR contract, RCAT has raised capital through several equity offerings each time they issue new shares. Existing shareholders' percentage ownership shrinks. This can put downward pressure on the stock price because there are more shares outstanding, and each share represents a smaller claim on future profits. As of the latest filings, RCAT's share count has more than doubled over the past year. If management needs more cash to ramp up RCHN ID production or pursue additional contracts, they may raise capital again, which could further dilute current holders.
In plain terms, imagine a pizza divided into 8 slices. If the company bakes more slices, issues more shares, but the pizza doesn't get any larger, each slice is now smaller. Unless the company's revenues and profits grow fast enough to more than offset that dilution, the per-share value will be diluted too.
On the flip side, the macro environment is favorable. Defense spending on unmanned systems is growing, and smaller drones are becoming essential. If RCAT executes well, they could become one of the first pure-play winners in the U.S. defense drone market.
Closing remarks. To wrap up, RCAT's Q3 2025 report was a tale of explosive revenue growth and mounting expenses. It's a classic high-risk, high-reward story.
If you're a risk-tolerant investor looking for exposure to the burgeoning military drone space, RCAT could be worth a look, but don't forget to keep an eye on future contract performance, cash burn, and potential dilution.
Thanks for watching this breakdown. If you found it useful, please like the video, subscribe to Earnings Digest Daily, and drop a comment telling us which company's earnings you want us to cover next.
See you in the next one.